Hello and welcome to Bloomberg Quint. I'm at the headquarters of HCL Technologies and I'm in conversation with Mr. C. Vijay Kumar, the CEO and President of the company, and also the CFO Anil Chanana here with me to take stock of how the quarter has been and what we can expect from financial year 2019. Gentlemen, thanks for joining us. CVK, 9.5% to 11.5% constant currency guidance that you've given us. What's been kept in mind with respect to this guidance, and is it possible that 11.5% could be the base case scenario for this financial year?
So we've given a guidance range which is 9.5 and between 9.5 and 11.5. I think we remain confident of our growth trajectory due to various positive trends. The first being our Mode 2 and Mode 3 offerings are becoming very compelling, and they're seeing an upward trajectory both in terms of number of deals and size of deals. We've also completed our verticalized go-to-market strategy for IT services globally, which is helping us to drive more business outcome-led propositions and solutions to our clients. And you've seen a good leadership in our growth leadership in our financial services, manufacturing, and we continue to look at strategic partnerships and acquisitions as well as a part of our growth strategy. So all of that gives us confidence. At this point, we believe we'll be in the guidance of 9.5% and 11.5%.
Excellent. Anil, again, investors are happy with the fact that there has been no downward revision of your guidance for FY19 as well. What are the challenges that you're baking in as well that could be a possibility and that could pressure margins going in?
The combination of our service offerings allows us a lever basically within the service offerings in order to enhance our margins. So while we have traditional offerings, which is Mode 1, and digital offerings as Mode 2, and products and platforms as Mode 3, the Mode 3 margins are better than the Mode 1 and Mode 2 margins.
Right.
So it allows us to sort of make certain margins and invest in our business. So the range which we have kept for ourselves is the desired range, and anything which is in excess we invest back into the business.
Right. I actually do want to address your investments and the impact it can have on margins. But before I go to that, CVK, what will FY19 be when it comes to HCL Technologies' role in transforming some of the legacy businesses and digitizing them?
Yeah, so if you look at our Mode 2 and Mode 3 services has grown close to 43% year on year, and our Mode 2 has grown close to 29.5%. So this is really our ability to transform our client landscape using the next generation services. So the Mode 2 deals are increasing in size, the number of deals are increasing. As I mentioned, we have 26 customers who had more than $10 million revenue in our next generation services in FY18. I think that's a momentum which is going to continue, and we are becoming more and more strategic for our clients. Our relevance of our service offerings is increasing. I think that's going to help us really be a partner in the digital journey of a number of our existing clients and prospective clients.
Right. There has been some slackness in organic growth, and of course we've all noticed that a bulk of your growth now comes through acquisitions. Is that also going to be the case, and what can we expect from organic growth then?
I think, as we had said earlier, whether it is FY18 or in FY19, I think our growth is balanced between organic and inorganic. And as I see in FY19, I expect it to be more or less equal in organic and inorganic terms. We do believe this is a great opportunity to invest and scale our business, and that's a strategy we are pursuing.
And among your recent acquisitions, Action Corp, or for that matter, the other one, C3I, if I'm not mistaken, this is largely in Mode 2 and Mode 3. And please correct me if I'm wrong here. What is going to be the acquisition strategy going forward?
Yeah. So three-pronged strategy. One is in Mode 1, our focus is going to be more of geographic expansion. So we continue to pursue opportunities, whether it is Australia, Germany, Canada, South Africa, some of these geographies where we want to make a bigger impact. That's number one. In Mode 2, we continue to look for opportunities around digital, cloud, security and IoT. I do believe we've made significant organic investments in Mode 2, but we continue to look for inorganic opportunities. And Mode 3 will be a combination of acquiring IPs and ability to create IP-led differentiated services. That will be the driving factor behind the Mode 3 services.
Okay. Anil, over the last 12 to 15 months, we've seen about a little over $1.2 billion being invested in IP partnerships. Are we likely to see an increase in this investment going forward? And in that case, in the short term, do you think that could have an impact on return on capital employed?
So I mean, over the last 2 years, I think you are absolutely right. We have spent about $1.2 billion in terms of this product partnerships.
Right.
And I think what we are doing currently is basically sort of a broaden that partnerships so that we have more partnerships with more players and more technology areas. So Actian is though it's not a partnership, but more of an acquisition, is a step in that direction. So enhancing our product portfolio, product and platform portfolio. So that is number one, as well as organically sort of make investments in the products and platforms. So that's one area of investments. While we have made these 1.2 billion over the last 2 years, we have been able to maintain our return on equity, which continues to be amongst the best in the industry, which is 25.1%.
Okay.
As well as keep our payout ratio as in excess of 50% of net income.
And are we likely to see an increasing amount being invested in IP partnerships, or is it too early to tell?
I think it will be a combination of product partnerships, it will be a combination of straight acquisitions,
okay,
as well as Vijay explained, in Mode 2 offerings and how we can expand the size of that, right, and footprint of that, and Mode 1 where we are looking at a enhanced geographic footprint.
Okay. Well, in that case, CVK, coming back to you, is there still delay in decision making when it comes to the infrastructure management services?
No, I think last quarter I had highlighted that things are back on track. I think we have signed a number of deals in the last quarter. We have a good pipeline. However, the deal sizes are coming down on the infrastructure business. Very similar to how the deal sizes are going up in the Mode 2 services. There is a reduction in the deal sizes, but we continue to win. There are a number of opportunities. So I feel more confident. As I indicated in H1, we will see a better growth in the infrastructure business, and that's really the commentary.
Okay, and one final question before I let you go is a question on the banking financial services space. We're still really not getting as much clarity, and I've spoken to a lot of your peers as well. There is still a lack of visibility, should I say, in as far as this vertical is concerned. What can you tell us about that?
See, financial services, we've really done very well. Right, I think we grew close to 16% on a year-on-year basis. So we have significant momentum, and this is really driven by the strength of our digital offering. Right, we've opened up a number of new accounts where we didn't have a presence, just with the help of our sharpness and the differentiated digital proposition. So I think I remain positive even in FY19. Financial services will continue to do well.
Okay. Gentlemen, thank you for joining us and wish you best for the new financial year.
Thank you.